In today's video, I want to discuss a new high-quality stock that I have added to my watch list, and I am now waiting for the right price to buy it. This stock has massively outperformed the S&P 500, and at the right price, I think it will continue to do so. However, with the S&P being so high, there's a lot of stocks that are expensive in the markets right now. So I think that it is a good idea to build a watch list of stocks and figure out the prices that they look like buys at before the market corrections actually happen. It simply always helps to be prepared as an investor. So in today's video, I want to discuss Palo Alto, what this business does, why I think it's interesting, and at what price I would consider buying it. Before we get into the video though, I want to let you all know that Stock Unlock has just released some massive updates. We just added in company-specific KPI data, like Apple iPhone sales, Netflix subscriber counts, and Equitable Bank's customer growth. We also added in the ability to generate an in-depth AI stock analysis report on nearly any stock, all with the click of a single button. With our new AI tier offering, you can now go to nearly any stock and generate an in-depth analysis that will cover its financial health, growth, profitability, management, and even its valuation. This helps you save time in your stock analysis and also allows you to make better, more informed investment decisions. I left a link to an AI-generated report for Palo Alto in the description of this video, if you would like to go and check it out for yourself and see what Stock Unlock's new AI stock analysis can do for you. But with that being said, let's now hop into the video. And let's start by discussing what Palo Alto does. Well, Palo Alto is a cybersecurity company and was recently awarded the leadership title in EPP and Firewall Solutions. An endpoint protection platform, or EPP, is a solution deployed on devices to prevent file-based malware attacks, detect malicious activity, and provide the investigation and remediation capabilities needed to respond to the security incidents and alerts. This basically means that Palo Alto can protect devices from cyber attacks. A network firewall is a security device used to prevent or limit illegal access to private networks by using policies defining the only traffic allowed on the network. Any other traffic seeking to connect is blocked. This means that Palo Alto can protect networks as a whole from cyber attacks as well, and keep networks and their data secure. Now, how I became interested in Palo Alto in the first place is because I was once invested in the company Fortinet. And one of the reasons why I ended up selling Fortinet a few months ago was because it was pretty obvious that Fortinet was losing market share to Palo Alto. So then I started to become more interested in Palo Alto. And additionally, for those of you who may not know, my YouTube channel was recently hacked by malware through my email, which really got me thinking more about cybersecurity and how important it actually is to have strong cybersecurity. So this really got me down the rabbit hole of wanting to look into the cybersecurity industry, being someone who was massively affected by a cyber attack. Then I started to do some research on the industry, and I found that the total damages in millions of US dollars from cyber attacks is absolutely skyrocketing. In 2023, it was $12.5 billion, and which is up nearly 6x over the past about 5 years. So cyber attacks are causing massive financial losses across the world, and it is only uptrending and actually looks like it is accelerating. And in this next screenshot, we can see the growth of the cybersecurity industry. And back in 2016, the cybersecurity industry was bringing in about $83 billion in revenue. And today in 2024, it is projected to hit $185.7 billion in revenue. So it has more than doubled over the past 8 years. Additionally, by 2029, the cybersecurity industry is projected to hit $272 billion in revenue, which is growth of another about 50% over the next 4 years, which is pretty steady growth. And with Palo Alto being a leader within the cybersecurity industry, this business has been seeing some pretty massive tailwinds behind it. For example, if we go and take a look at Palo Alto's financial statements here, we can see that its long-term revenue growth has been absolutely incredible. And every single quarter in the company's history, it has posted revenue growth. And it looks like this trend is only continuing. If we take a look at Palo Alto's operating cash flow growth, we can also see that it has been trending up massively. It's not quite as steady as the overall revenue growth, but we can see that this company's operating profits are clearly going up and trending up with the revenue. If we continue to take a look at Palo Alto's cash flow statement, we can see that it produced about $3.16 billion in operating cash flow in the trailing 12 months, and its capital expenditures were only $147 million, which is about 3% of the company's overall operating cash flow. This means that about 97% of its operating cash flow becomes free cash flow for the business. And here we can see that in the trailing 12 months now, the company has produced about $3 billion in free cash flow. And again, almost all of the operating cash flow becomes free cash flow for the business and for its shareholders. And this is why I love these software companies like this, because they have very little capital expenditures, which means that as the operating profits continue to grow, so does the free cash flow. However, it is not all sunshine and rainbows for Palo Alto's cash flow statement, because in the trailing 12 months, the company has had about $1.06 billion in stock-based compensation, which is about 30% of the company's overall operating cash flow. And 30% of operating cash flow being stock-based compensation is a very high number, and it's actually on the higher end of what I'm even comfortable with. So I do actually see this as a little bit of a red flag, and it is something to definitely note when you are taking a look at this business. And the reason I do not like this high of stock-based compensation is because it leads the overall share count to continue to grow. And if we take a look at Palo Alto's historical share count, we can see that it has continued to uptrend over time. And since its IPO, its total share count is up roughly 80%, and it is increasing by about 3 to 4% annually at this rate due to the stock-based compensation that is going on. So there is some slight dilution happening to shareholders over time. So now let's go and take a little bit of a deeper look at Palo Alto's most recent quarterly data. And here we can see that for the third quarter of 2024, the company's revenue grew 15% year over year. Then down at the bottom, they give the financial outlook for next quarter. And they say that total billings are expected to grow between 9 and 10%, and total revenue is projected to grow between 10 and 11% for the fourth quarter. So Palo Alto grew its revenue by 15% year over year for the last quarter, and it is expecting about 10 to 11% revenue growth for the next quarter. So it seems like the company's revenue growth is decelerating, at least for the time being. In the screenshot from the company's most recent quarterly investor presentation, we can also see that its different business segments' revenue growth is also slowing down over time. And this is kind of natural for these high growth businesses. 30, 40, 50% revenue growth cannot be maintained forever. The law of compounding simply doesn't allow it because we live in a limited world. So eventually these high growth businesses' revenue growth does have to start decelerating and slowing down. And you can clearly see that for Palo Alto. Now, personally, I do not think that this is a red flag by any means because it is just the nature of business and these high growth businesses. But it just means that, maybe I want to pay a little bit lower of a multiple for this business because it's not growing as rapidly as it once was. Now, in this next screenshot, we can see the overall cybersecurity industry by market cap and revenue growth. These little yellow diamonds are the revenue growth of the different businesses. And here we can see that Palo Alto is actually the largest company in this industry, and its revenue growth is actually on the higher end. When we compare the revenue growth to Fortinet, we can see that Palo Alto's revenue growth is actually higher, and it is a larger company. Now, what this overall means is that Fortinet is most likely losing market share to Palo Alto, as I said earlier on in the video. And this is kind of why I am more drawn to Palo Alto now instead of Fortinet. Now, if we head over to Stock Unlock's Freeform tool, we can take a look at Fortinet versus Palo Alto's revenue growth over the past 12 years. And Palo Alto is this kind of red line, and Palo Alto is this more kind of red line. And we can clearly see that Palo Alto's revenue has been growing much more rapidly than Fortinet. And it looks like Fortinet's revenue growth is actually decelerating quite a bit right now, whereas Palo Alto's is continuing to grow at a pretty decent pace. And if we take a look at these two companies' operating cash flows, this is the exact same story. Palo Alto's operating cash flows have been compounding much more rapidly than Fortinet's as well. So now let's take a look at Palo Alto's price to free cash flow since 2016. And here we can see that its historical average has been about 25.3, and the company is currently trading for a price to free cash flow of about 33.4. So it is actually trading above the high end range that it likes to trade for, at least historically. So I do think that the stock is actually a little bit expensive right now. And in general, I do think that a 33 price to free cash flow for about 10 to 15% revenue growth is on the more expensive end. So since Palo Alto is trading above its historical average price ratios, and it is trading for a high price ratio relative to the business's underlying growth right now, this is the reason why I am not buying the stock at its current price. But if the stock does come down, then I would be more interested in buying it. And I would be interested in buying it around its historical average price to free cash flow ratio of 25. What's also interesting is that back in the stock market crash of 2020, Palo Alto was trading for a price to free cash flow of 15.8. And back here in January of 2023, it was also trading for a price to free cash flow of 16.7. So this stock, at least historically, has traded for price ratios below 20. These are kind of during massive market corrections, but I'm just wanting to point out that this is a high quality business that historically has had periods where it does trade for pretty attractive prices. And now going forward, since this one is on my watch list, I am definitely going to be watching for these types of opportunities on Palo Alto stock in the future. Now, this next screenshot shows that Palo Alto is expecting its NGS annual recurring revenue to hit $15 billion by 2030. We can also see here that it is expecting its billings growth and its overall revenue growth to start reaccelerating at some point in the future. Additionally, Palo Alto's NGS annual recurring revenue is guided to hit about $4 billion for the year of 2024. And again, they are projecting $15 billion of NGS ARR by 2030. So this segment of the business is projected to continue growing quite rapidly, and this is the fastest growing segment of Palo Alto's business as well. We can also see that analysts are expecting Palo Alto to compound its revenue by about 14.5% annually out to 2028. So they are expecting about 15% annual revenue growth for Palo Alto over the next 4 years. And I do think that Palo Alto could probably hit this 15% annual revenue growth all the way out to 2030. So what I did is I entered in these metrics into Stock Unlock's discounted cash flow calculator to see what the fair value of Palo Alto is today. So here we're projecting out the company's free cash flow over the next 5 years at a 15% compounded annual growth rate, which basically means that Palo Alto's free cash flow will grow in line with the revenue. I also entered in that the company will dilute shareholders by about 3% annually due to the high stock-based compensation that the company does. Lastly, I did put in a 25 price to free cash flow, which as we saw is Palo Alto's long-term average price to free cash flow. Now, when I entered in these metrics, we get a compounded annual growth rate to the stock of about 4.73% from its price today. Now, as we all probably know, this is below the S&P 500's historical average return rate of about 10%. So for this reason, I do think that Palo Alto is selling above fair value today. And based on these metrics that we inputted here, for Palo Alto to produce a 10% annual return rate, the stock would have to be about $250 per share, or about 22% below where it is currently trading. So in my opinion, this is around the fair value for Palo Alto stock here, is right around that $250 per share price. So if Palo Alto ever does get back to the share price, then I will start to become much more interested in the stock. But for now, it is on my watch list and it is one that I am just paying attention to and waiting for a larger correction to come if it ever does. So yeah, those are all of the reasons why I am interested in Palo Alto stock, which is PANW. And that is the price that I would start to become more interested in the stock as well. I also pointed out some of the goods and the bads with the stock. The goods is that this business has been growing incredibly well, and I do think that there is strong tailwinds behind the business. However, it does have a lot of stock-based compensation going on, which has diluted shareholders quite significantly since the company became public. So there are some good and bads here that everyone should definitely be aware of. And again, I did put that AI stock analysis report in the description if you want to go and check it out, because it will elaborate on a lot of what we talked about in this video and provide some additional insights. And if you're interested in checking out Stock Unlock's AI stock analysis feature now, then make sure to head over to stockunlock.com because this is a brand new feature that we just launched and we're getting a lot of great feedback so far. So make sure to head over to stockunlock.com and check it out for yourself. But with that being said, thank you all so much for watching. If you did enjoy this video, then please remember to leave a like on it. And if you're new here, then please consider subscribing to the channel as well. But that's going to wrap it up for today, everyone. So thank you again so much for watching. I truly do appreciate it. And I really hope to see you all again in my next one.